Hi everyone, welcome back to the channel. Today we are going to talk about one of the most misunderstood but absolutely crucial concepts in trading: developing a strategy with positive expectancy. Now, that might sound complicated, but don't worry, we will break it down step by step. By the end of this video, you will understand not only what expectancy is, but also how actually build a trading plan that gives you an edge in the market. An edge similar to how casinos stack the odds in their favor. And here is the best part. You will see why being right in trading is far less important than you probably think. Trading success starts with building an edge, not chasing certainty. What is an edge? Think about a casino for a moment. Roulette wheels, blackjack tables, slot machines, they all have one thing in common. The house always has a slight edge. It is not huge, but over thousands of spins or hands, that tiny edge guarantees the casino consistent profit. In trading, our goal is the same: develop a strategy with positive expectancy. Expectancy simply means, on average, how much do you stand to gain or lose per dollar you risk over the long run. There are four elements that create your edge: your win rate, how often you are right; your loss rate, how often you are wrong; the average size of your winning trades; the average size of your losing trades. That's it. Everything boils down to those four numbers. Your edge is nothing more than math working in your favor. Nothing. The story of John and Steve. Let's make this real with an example. Imagine two traders, John and Steve. Both take 100 trades with the same starting capital. John wins 75 trades and loses only 25. That is a 75% strike rate. Steve, on the other hand, wins just 30 trades and loses 70. Only a 30% strike rate. At first glance, John looks like a superstar trader, right? Winning 3 out of 4 trades. And Steve, he looks like a disaster. But here is the missing piece: their reward to risk ratios. John makes $1,000 on each winning trade, but loses $3,000 when wrong. His risk is 3 times larger than his reward. That's a negative risk to reward ratio of 1 to 3. Steve makes $3,000 when he is right, but he loses only $1,000 when he is wrong. That is a positive ratio of 3 to 1. Now, let's calculate expectancy. John, despite winning 75% of the time, he breaks even. His big losses wipe out his small wins. Steve, despite losing 70% of the time, averages positive $200 per trade. So, who is the better trader? It's clear, right? It's Steve. This example proves a shocking truth. Your win rate doesn't matter nearly as much as how much you win when you're right and how much you lose when you're wrong. Being right often doesn't make you a winner. Expectancy does. Profitably models. There are basically two models of profitability in trading. High strike rate strategies, where you win most of the time but often take smaller profits. High reward to risk strategies, where you win less often but your winners are much bigger than your losers. Most professional traders lean toward the second model because you can actually be wrong more often than not and you still make money. Let's put numbers to it. With a 3-to-1 reward to risk ratio, you can lose 7 out of 10 trades and still end up profitable. With a 1-to-2 ratio, your losses are double your wins, right? You would need a 67% win rate just to break even. This explains why most retail traders lose money, even though on average they win more than half their trades. Their losers are simply bigger than their winners. So, you can lose more trades than you win and you still get rich. Psychology and probability. Here is the hard part, the psychology. It feels good to win often, so most beginners chase high strike rate strategies. They cut winners too early and let losers run, hoping trades will turn around. What is the result? A negative expectancy strategy. On the other hand, high reward to risk strategies require accepting frequent losses, right? That can be painful at first, but over time, once you internalize probability, those losses stop hurting. You simply see them as part of the game. And once you can accept that, trading becomes much easier on your mind. The real battle is not against the market, but against your own mind. Expectancy on the charts. So, how do we apply this practically? When you open a trade, you have two boxes on your chart. One box for risk, defined by your stop loss, one box for reward, defined by your target. The goal is simple. Keep the risk box as small as possible while allowing the reward box to grow as large as possible. For example, a 20 pip stop loss with a 20 pip target means 1-to-1 ratio, right? Break even over time. A 20 pip stop loss with a 60 pip target means 3-to-1 ratio. Profitable even if you're wrong 70% of the time. This is what having an edge looks like on the charts. A small risk box and a big reward box, that is what edge looks like. The big takeaway. So, here is what I want you to remember. Trading is not about being right. It is about making more when you're right than you lose when you're wrong. Expectancy is the only metric that truly matters. Focus on small, controlled losses and let your winners run. Build a strategy where, over the long term, probability works in your favor, just like a casino. If you can do this, you will shift from gambling in the markets to trading with a real, sustainable edge. In trading, it is not about being right. It is about lasting long enough to win. Thanks for watching, guys. If you found this video helpful, hit the like button, subscribe, and let me know in the comments. Do you prefer a high strike rate strategy or a high reward to risk strategy? Remember, it is not about being right all the time. It is about positive expectancy. Positive expectancy turns trading from a gamble into a profession. See you in the next video.